Welcome to the Debit This, Credit That podcast with Wheeler Accountants, located in San Jose, California. In this podcast, we discuss how to solve accounting challenges in both your personal life and your business. We take an energetic, tech-savvy approach to solving accounting challenges that steal your focus and your time. Now, on to the show with your tech-savvy accounting experts, Matt Wheeler and Michael Bryant.
Welcome to episode 23 of the Debit This, Credit That podcast by Wheeler Accountants with your hosts, Matt Wheeler and Michael Bryant. Today we have a special podcast. This is actually our first ever podcast with a guest on the show. We have Brandon Knapp, a branch manager at RPM Mortgage in Campbell, as our guest today. Whether you're purchasing your first home or you're a seasoned real estate investor, Brandon's knowledge of finance and focus on detail will make the process of obtaining a home loan a seamless experience. Brandon's outstanding reputation has been built on his ability to take the frustration and guesswork out of the loan process and deliver what his clients need, a wide range of financing options and successful results in a timely manner. Brandon actually began his career in finance as an accountant for PricewaterhouseCoopers, where he established himself as both a great team member and an effective leader. It's his desire to interact on a more personal level with his clients that he eventually pursued a career in the mortgage industry. Today, as a partner and senior mortgage planner at RPM Campbell, Brandon brings a wealth of knowledge to each loan transaction. I can actually personally vouch for Brandon. He helped me and my wife purchase our first home or get a loan, purchasing our first home this summer. My taxes are a little bit more complicated being the owner of the accounting firm and a couple other small businesses. And Brandon was able to make the underwriting process about as painless, I think, as it could be for what would normally be a pretty complex situation. I'll say I don't have the highest opinion of underwriters generally based on my experience as an accountant, what they're always asking of me, but Brandon did a really great job helping us out, and I really appreciate it. Brandon, welcome to the podcast.
Oh, thanks for having me. I'm excited to be here. I think this is pretty awesome you guys are doing this.
Thanks. Well, we got a few things I guess we could talk about today. I thought first, though, there was an article or whatever on Zillow that came out the other day talking about San Jose being the hottest real estate market in the country, right? And I thought you could maybe give us a little bit of a current state of the mortgage market and the real estate market here in Santa Clara County and San Jose.
Yeah, absolutely. It's unbelievable. I mean, every January we talk about it in our industry about the inventory is the lowest we've ever seen it. I think last January we were in the 700 to 800 range, and then we opened up this January.
What's normal?
What's normal? Well,
a healthy market.
A healthy market where there's normal negotiation, not the craziness we see today, is in the range of 3,000 to 4,000 homes on the market. And we opened up this market at 400 homes on the market.
Wow, that's a significant reduction.
Yeah, unbelievable. And in that 14 townhomes and condos. In Santa Clara County. So,
is there anything under $1 million?
I think there's listings under $1 million. Yeah. But there are some condos. I did have actually a client buy a condo in the last 3 months for, believe it or not, less than $600,000 in Santa Clara County. So they do exist, but very hard to find, and there's a long list of people trying to get them.
And is that like just Santa Clara County? Are we talking like the broader Bay Area is also that tight? Or then how's that compared to nationwide? Or
Sure.
do you really know much?
Yeah, we do keep track of that, or at least on top of what's going on in the market. In fact, everywhere we're talking, we have RPM mortgage offices all throughout California and the West Coast, and we're inventory's tight in Seattle, Southern California, and believe it or not, where I grew up down in the Guam. I was just talking to a realtor over there about some things, and he said that they have an inventory shortage, so it's made it all the way to Guam, which is just blew me away because I thought we were the ones dealing with this, but it's everywhere.
Why do they have one in Guam?
Well, the big thing on Guam is that with all the immigration law changes, a big factor in their construction is using H-2 visas, and they've not allowed H-2 visas right now. So any qualified worker usually on the island is working for the military because it pays well and it's a great job. And so there's just a shortage of labor, which is the same thing here. There's a shortage of labor. Now there's a shortage of labor everywhere, including Guam, which is interesting. So yeah, so that's the biggest issue over there. So
it's crazy. So we have a lot of clients, I think, that'll find this podcast interesting. And, one thing I think in particular is having gone through it myself recently, like a first time home buying experience. Do you have any tips or suggestions for people as they're about to prepare to buy their first home or buy a home to make like the underwriting and mortgage process more smoothly? Things they can do in advance to be prepared, because from my perspective as a CPA, I often get these requests that come, it seems like the 11th hour and like it must happen today kind of thing, which just doesn't sit well with me a lot of times. But
we do see that a lot.
Yeah. What can clients do to avoid some of those things and be really prepared going into the process?
Yeah, no, thanks for asking. I think, honestly, there's two things that stand out. One, sit down with a qualified, reputable loan officer that has lots of different options. You want a wide range of options, especially in the Bay Area when you have, just a wide range of compensation, stock-based compensation, all types of income, self-employed, all the smart people we have around here, we're constantly seeing this virtual currency or Bitcoin and Ethereum, all these different things coming out. So I think you need to have someone qualified. But in addition to that is getting all your documentation in. I would really recommend putting the effort up front, get everything into your loan officer and into underwriting up front, and then that'll save a lot of problems.
So what do you need if you're like a, W-2 employee type person? Like what are the things you need to have ready to go for the underwriting process?
Sure. Yeah, it's usually two W-2s, 2 years tax returns, 2 most recent pay stubs or a month's worth of pay stubs, and then 2 months of your asset statements, retirement statements, bank, checking, savings, investment. If you get all that into underwriting up front and early, then any questions can be vetted up front. In fact, we do this program called an advanced approval, and when we have clients who are willing to put everything up front, then we can get it all the way through underwriting with very few conditions left over. And it's basically saves a lot of problems and allows you to close in 15 days, which is needed a lot of times in some of these markets.
It would reduce those requests that are coming in at the 11th hour for us.
Yeah, absolutely, especially for you guys, because I could see that. Sign this letter. What about that? I can imagine all the requests you guys get, especially with the wide range of clients you have. But I would say if you get it all up front, get in front of an underwriter, get the full approval, they've vetted it out. It's not somebody saying, well, I think you're going to need this. It's like, get this letter written, get this done from your CPA, get all those things up front. It's all in. It will be it'll take a lot of stress out of the process.
And so there's also like a pre-approval that happens before like the official approval. Could you describe that process to our listeners out there, like how the pre-approval process works and what you need there versus when you're like officially approved for the loan for funding and everything?
Sure. Yeah. So usually what happens is most clients will turn in their documentation and say, hey, here's my income. Here's my, run credit. Look at my expenses and look at my assets. And then it goes through the underwriting process in just a preview of it. So it goes through a system. It says, yep, your income, your debts, everything looks to approve you for X loan amount. And then there's a bunch of conditions. And the conditions can be a letter of explanation about why you live here, why you're buying this property or that property. So there's a lot of different conditions that can come up. And then everyone just kind of sits and waits, and then they find a house and they say, oh, okay, I better satisfy all these conditions. And sometimes it could be 20 conditions or it could just be 2. The further along you get in that process by doing like an advanced approval, you actually satisfy all the conditions up front, even before having a house. So it's like the funds are ready to go within the next 15 days.
Because you got to move fast, especially in this market, right?
Yeah, exactly. Yeah. So having that, the pre-approval is like, I vetted everything. You're going to get a loan. The underwriter looked at it. You're approved. But there's still a lot more to go. And we'll wait till you get your house and then get everything else in. You can go that way, but it does cause these last minute scrambles on. Yeah.
And my sense is that's probably part of the point that happens a lot of times where if a person's not prepared and like once they get the pre-approval, they end up like house hunting for a while and now they need to update all like the statements and pay stubs and everything. And if they don't have that stuff like at the ready and organized, that's where they're kind of scrambling near the end of the process again to make it all happen again.
Yes. Yeah, that's correct. Good point. Yeah. So a lot of it, or someone's packing or they're traveling and then it's a scramble at the end. So, a lot of times we'll tell clients get everything up front, get the full approval, and then just keep track of your pay stubs. If it takes a while to find a house, keep track of your bank statements and just have them ready to send. We always would love it if clients just sent them in as they come along. Like, hey, I got a statement. Here you go, store it. That's fantastic. It's rare that happens because everyone's so busy. But if you could keep track of those updated items, which would be updated pay stubs, updated asset statements, coming up here pretty soon. W-2s are going to be issued for 2017. So we'll need to start getting 2017 W-2s.
Right.
Tax returns can just be on extension. If you're on extension, you don't need to provide the return.
And you guys had a pretty slick, like, online tool, I recall, where it was like a kind of a wizard thing you went through and it asked you to kind of fill it out, at least for like the whole pre-approval thing, right?
Yeah. And so that's, there's a big movement in the mortgage market to go to this, what we call digital mortgages, right? And, I don't think it'll ever go all digital just because the market wants to keep the rates low, to keep the bonds and treasuries in check. They want to make sure that the documentation is there, right? And the more documentation, it is a pain for all of us, but at the same time, it keeps rates low and it keeps us looking, feeling good about the values in our neighborhood, that people aren't just going to take a chance, put their name on an application, get a loan, and then not be able to pay it, which would cause, the issues we had in 2008. But I would say, we have this great online tool. In fact, I worked with a Sharks player recently, and it was unbelievable. We closed his loan in less than 20 days. He would sign disclosures before I can even send the email that said, hey, you got this in your inbox. And I couldn't believe
Not during the game, I hope.
Yeah, not.
Well, and I knew it was practice time, so he said anytime. So we would send it to him right when, I was like, I couldn't believe it. I called him up. I said, that's the fastest. I couldn't even send you the email. You already signed. He goes, well, yeah, I took a look. It was good. Got on my phone, knocked it all out. So,
Wow, you can do it on your phone. That's really nice.
Yeah, you can do a lot on your phone these days. It's pretty neat. Actually, when I bought my house, the final offer we made, I was like, we were up in like Lassen County and barely had cell reception, so I had to drive into town and do it on my phone in front of this old market that was out of business. I'll never forget it. But
I remember that. Yeah, I remember you're like, I have 2 hours in reception. So, but yeah,
make it happen for now.
Yeah, it really does. It does help. Some of this helps, especially with, I've had many clients who are overseas during the process. So being able to e-sign, being able to upload your documentation, and on some loans, actually, if you give authorization and they have the right payroll system and banking system, we can actually pull their reports. So
that's cool.
So that's kind of cool, and that's been happening more and more. It works for all conforming loans and on some jumbo loans. So just case by case, but that's really taken a lot of the paperwork out.
So for a W-2 employee, I'm hearing you want to keep all your pay stubs and bank statements and that kind of stuff, and probably, keep good records and maintain that, download them every single month as you're in the middle of the process until you close the loan and everything. But what about, now let's kind of shift gears to the self-employed taxpayers, or the people that kind of have a little more complicated taxes. What do they need to do to be ready in terms of getting the pre-approval and everything? That their taxes are obviously going to be more complicated and different. And how do you guys differentiate yourselves, and you particularly, on being able to get those loans done?
Sure. Yeah. Thanks for asking. I think one, it's 2 years tax returns. We'll look at net income, but some of the things that we can do, I had an accounting background, and it's helped a lot when we look at tax returns, because there are some things in your tax returns you can add back that don't count towards a deduction that can actually give you more income than what the face of the tax return is showing you. So I think being able to understand all the parts of the tax return, and maybe there's a debt in there that's already paid off that was on the tax return, and being able to show the underwriter that debt doesn't exist anymore. Therefore, let's add that back and give them more income. So depreciation would be another thing. So just really looking at the tax return, trying to figure out ways to give more income that's shown on the face of the tax return, per the guidelines. And then the other thing is staying in touch with the client throughout the process. For example, if you had a really good 2016 and 2017 was a little slower business-wise, you're going to be asked for a P&L. So at the face of 16, everything might look great. So you might want to look at your 2017 P&L, make sure everything's in line and ready to go so that you can buy a house. And the reverse of that, you might have a fantastic 2017. 16 wasn't as strong. So then we can give some advice around what to do in 17 to make sure you can use that income to qualify for the best loan.
So you guys usually need the current P&L type stuff for the business, right? Some sort of profit and loss statement.
Yeah, correct. Most underwriters, almost all underwriters, will ask for 2 years tax returns and then the most recent P&L balance sheet. And then, we start with that, and then we kind of dive in there, and then we can ask for some other things to try to prove more income.
So keeping up on their accounting records during the process is really important.
Yeah, very important, absolutely. And I think, it's almost like a mini audit, right? I mean, we're going to dive into everything, but the more we do this, it isn't fun sometimes to ask clients for some of the documentation, but it helps us target the best program for them, the best rate, and get them to the highest price, which is what they need right now. The other thing actually that we've been doing lately, which is interesting, is for high cash, let's say businesses, hair salons. There are bank statement loans now. So if you show a 24-month history of enormous cash flow coming in, and you have great reserves, and you meet all these other requirements, you can actually use the cash flow coming into the bank as a source of income.
Oh, interesting.
So you just add up all the deposits. You don't need to have like an official P&L or
That's
anything.
correct. Yeah. Or you might, so what they'll do is they'll add up the deposits and then they'll take a small deduction for business expenses.
Mm-hmm.
And then they use that as the documentation. And they're definitely portfolio loans, a little bit higher rates, but I mean, we did one not too long ago for a house in San Mateo, and the rates were in the mid fours, but for what you're getting, I mean, they went to 4 other banks, they could not get a loan, and they were able to close on a home with a good loan.
That's awesome.
Interesting. So we're in a really competitive market, as you mentioned, that the inventory is really low. We hear a lot about cash only deals. So offers being all cash. How does a buyer compete in that type of market, and how can you help them?
Yeah, that's a great question. That is a big challenge, especially early last year. There was money from all over the world coming in, and cash buyers were winning on almost every deal. So one of the things we really push to do is be able to close fast. So I mean, I've actually closed some jumbo loans in 12 days.
Wow.
So that's important to be able to close fast. But the other part of it is contingencies. So when you go to make an offer, a lot of buyers will put in a contingency somewhere around 10 days. That's where you get to do your inspections, your appraisal report. And, if somebody walks in with an all cash offer, it's hard to turn that away as a seller.
Mm-hmm.
So if you can come in with a really great offer on price, you can close quickly so the seller can get their money within a reasonable time of, not much longer than the cash offer. And you remove your contingencies, which I'm not always advising, but we do have checks and balances to make sure that's appropriate for each client. But you remove your contingencies, you're going to have a higher chance of getting your offer accepted. And I would say 50% of offers, at least 50% of offers go out non-contingent today.
Really?
Yeah, you put your deposit down.
It's not a healthy market.
You're saying, I put my deposit down, I'm buying the house, or if you walk, you lose your deposit. So, the only way to do that is you have to have the financial reserves to cover the appraisal difference. If that was to ever happen, if it was to ever come in lower, you would want to make sure this is the house you absolutely want, and your deposit's at risk. But you also want to make sure you have multiple loan programs available so that if one loan program you thought you were getting didn't work out for some reason,
mm-hmm.
there's backup number 2 and 3. I will never let a client go non-contingent unless I have 3 options for them that I can assure they will have a loan. And I've told clients that want to go non-contingent when I know there's only one loan option, maybe because of a past credit history issue or something like that. And I will just say I cannot put my reputation and your money on the line for that. So it's really important to have those types of products available to be able to do that.
Yeah. Well, because from the seller's perspective, when it comes in non-contingent like that, it is the same as cash, basically.
That's right.
Right.
Yep.
That's how you're able to compete.
Yep. And most offers right now, I'd say 99% of offers, the seller requires to see your funds for the down payment when you submit your offer.
Proof of funds.
Yeah. So your proof of funds. So you submit your contract, you submit your proof of funds showing that you have the funds available. And so you do that, you go non-contingent, and that gives you your best shot against cash. Fortunately, I think there's less and less cash deals, but I'm still hearing it all the time.
Okay, so you're seeing that trend go down a little bit.
Yeah, absolutely. It definitely is going down. But, every market's different. One market all the markets are hot and some just are out of control. 500,000 over list price and all cash. And it's just, and it's kind of changing depending on maybe where people get tired and then they move to the next town.
Going back to the down payment thing real quick. So we get a lot of clients that ask about like assisting an adult child or like grandchild with the purchase of a first home. And I know you got to like have the fund seasoned for a period of time. There's different strategies on how you can do that. And some of them are tax related in terms of like co-ownership versus gifting and that kind of stuff. But from the mortgage perspective, the underwriting perspective, what do clients need to be aware of when that kind of stuff pops up?
Yeah, absolutely. That's a great loan. I love doing loans where a family's involved only because it's awesome to see, it's what we need essentially in this area a lot for someone to buy a house is to have some support from family. And unfortunately, not all of us have that, but if you can get that, it can be a big advantage. So some of the areas that I would say for a family member to help out would be they can co-sign, then use their income as a help qualify for the loan. They could actually lend money as a second lender, so they could actually come in and supplement with the first lender.
But they're second in secured interest,
second secured interest, yeah. And then they don't have to really go on title, so they basically don't co-sign. I mean, they co-sign, or they could just become a second lender and provide funds.
If you co-sign the loan, you're still not buying also, though. Are you on title then? Do you have to be on title? Or?
Most of the time you have to be on title. There are loans where you don't have to be, but in most cases you do go on title. So by co-signing, you're putting your credit up, so it will show up on your credit report. Down the road, I've had parents ask, well, will this affect me if I go do a loan? And typically, if you keep track of, 6 months or a year out of the payments being made by their child, you can offset that debt on your credit report when you're going to qualify for a loan. So it can impact you for a little bit, but you need to be aware that loan will show up on your credit as well. But
so if you establish some sort of history where the adult child is servicing the debt, then they don't end up counting it against you, basically?
That's correct, yeah. So keep track of if you do co-sign, keep track of records of payments being made. Don't do a commingled account and then write it out of there because you can't prove that it's coming from the actual person living in the house. So that's important. Giving a loan, I've done that a lot with somebody who's retired and said, well, I don't really want to put my name on the loan. I would just like to help out. How do I do that? So making them a second lender, maybe they're earning 2% on their money in an account. You could, I say, hey, I tell our clients, like, if your parents will give it to you at 5%, that's an awesome deal. They're making money. Mm-hmm. They're helping you. It's a perfect sort of, workaround to get them financing and avoid either, and get them to a higher price point or get them better terms on their loan.
And we can end up gifting part of the principal away later, like every year with the annual gift exclusion and that kind of stuff. So we're able to slowly reduce the debt, but not do it all at once in one big taxable gift.
Yep, absolutely. Yeah. And it's a great estate planning strategy, right? Mm-hmm. They could use that if they're like, hey, I'm going to do this eventually anyway. So, and then you guys could work with them on the best strategy on how to do that. And they can just give a gift also, within their estate limits, they can give a gift to a child as a down payment. And, for most loans, they can give as much or as little as they want towards the down payment.
And so, if that gift is done within the first couple months before the pre-approval, they got to write like some sort of letter or something to the lender. But if they did the gift before then, there's nothing required from the underwriter if the funds are, quote, seasoned long enough in the account. Is that
what does
accurate?
Seasoned mean?
Yeah, that's a good question. So seasoned means if the funds are in the account and you have 2 full statements without the funds coming into the account, because they're going to audit 2 full statements and ask about any deposits coming into the account. So if they received funds from the family member prior to that, they have an account. It was 50,000 3 months ago, and then they deposited 100,000. Now it's 150. You have 2 accounts at 150,000. You get to use the 150,000. No other questions.
As long as you have 2 months worth of history of it just showing in there, not coming in the account.
Correct. Yeah.
Yeah, we get that kind of questions a lot, but I do generally advise clients that, either, call it a gift and consider the money gone, or if you're really talking about doing like a second lender situation, they probably should do it correctly, with you or whatever, or, they absolutely need to get the loan secured by the house later on, because if your kid's going to pay you back and pay interest, they can't deduct it as mortgage interest unless the loan's secured by the home. And, they're also at risk, right? So it's not just not trusting your kid. It's, someone sues your child or something, takes the home, and you're left out to dry if you didn't have your loan even second behind the bank, right? So it's just good general advice, I think, to make sure you get secured on there. If you tend to treat it as a loan, not a gift, make sure you do the proper work there.
Document that loan and make sure that it's properly recorded.
Yeah, absolutely. I think, 1, to protect their asset, and also 2, from your perspective, maybe through an audit, to be able to document it, right, and show that what the intention of the money was. So yeah, I think those are all great points on how someone can help. And I think if somebody has access to family contributing, there's a lot of great ways that people can, a lot of great programs that allow gifting. And then the last thing I would say is that if somebody does give a gift, they don't have to actually give the money to the adult child right away. They can actually just wire it to escrow at the end. So they don't, it causes more paperwork. Actually, if you give it to the adult child, then the adult child has to show where it came from. Mm-hmm. And there's a lot more, paper trail that has to be done when I've told people this, they really love that ability to just go, okay, I'll just give it to escrow when you're about to close on the home. About 5 days before closing, the wire goes into escrow with the gift letter that was sent in earlier, and that's it. So it makes it look
nice and clean. Yeah. Do you think with the tax reform, the new law that came out and the whole $750,000 maximum mortgage limitation, do you think that's going to impact housing around here at all, or have any clients been asking you about that?
Yeah, I have been getting that question a lot lately. The intellectual side of me says it should. What I'm sitting here and when I talk to clients on a day-to-day basis and the tight inventory and the amount that people are overpaying, I think there's just too much demand for the inventory that I think people are shrugging off the tax consequences,
Mm-hmm.
And they were already getting loans that were over $1 million anyway, so.
Yeah, correct. So I think if you look at it, it's about $250,000 of mortgage that the interest on that they're not going to deduct. So I think the property tax part, and then you know better than I, but I would say a handful of people that have had alternative minimum tax in the past didn't get to deduct most or some of their property tax. So, as I'm running some of the numbers and just kind of doing my estimates, it doesn't seem like the impact is significant, although I do think some people will, and especially if you're just getting in, $1 million house and you're, just getting going, there's probably some impact that you have to account for.
Yeah, I think people definitely feel it, but part of the deal is interest rates aren't that high still, and yeah, you lose the deductibility of the interest on, $250,000 of the debt, but compared to the total home price and total payments, that may only be like, a couple $100 a month difference, and it may not be this like material amount compared to what you're already paying anyway. So it may not impact the decision that much.
Correct.
But it is a bummer.
Yeah, it is a bummer. It's not, obviously I don't want that to go through, but I think that the overall dollar amount isn't material in the big picture in this area, especially. So yeah, I don't see it being a huge impact right now at least with the clients we've been talking to.
So I know that you had worked on Matt's purchase of his first home, and you had just mentioned that you had worked on one of the Sharks players. Can you give us some examples of some complex or innovative lending scenarios that you've worked on?
Yeah, absolutely. So I would say, the biggest challenge with this inventory shortage is a lot of people feel stuck in their home. They're sitting there saying, well, I want to move, but I don't want to sell my house and then not be able to find a house. And then if the market keeps going up, have to chase the market. So I want to be able to secure a home, buy a home, make the move, and then sell my house. And it could be for, having kids, school, you name it. So there's a great program that we've been doing a lot of this past couple of years, and that is a program where it allows you to buy a home before selling. The typical way is you go into a bank, you say, hey, I want to buy a house. They say, okay, well, we're going to carry your debt on your current house and the debt on the new house. Do you have the down payment? And as long as you have the income to qualify for all of it, which is significant when you're, maybe selling a house for $1 million and trying to buy a house for 1.5 to $2 million, you could do that. So if you have the funds, you have the income to qualify for everything, it works out. But if you don't, or if there's other things like I'm self-employed and I write off these expenses and it just doesn't, there's a lot of parts to everybody's tax returns that are a little more complicated. I think that you can use a program we've been doing where when you're in your house, you get a rental survey on the house that you're leaving. So you're selling your house. You tell the bank you're selling your house. You get a rental survey. So let's say your house will rent for $4,000 to $5,000 a month. You can use 75% of that income to qualify for the next purchase. Even
the hypothetical income.
The hypothetical income. You're not renting it. You don't need a rental agreement. You literally get a rental survey from an appraiser that says the market is paying this much for your house. Now you take that income and you offset the debt on your house. So it basically, in most cases, wipes out the cost of the home. And now you're just going to buy the next home. And you can do one of two options. You can get, actually three options. If you have the funds for a down payment, that's great. You have your down payment. You go qualify for the next house. You buy the next house. You sell your house, and then you recast your loan on the new house. So you basically take the equity from the old house, roll it into the new house in the end, and that's how you get into a house without selling first. The other option is you can put a home equity line of credit on your house, tap into the equity in your home, and that gives you funds to use for the next down payment. So that's a great low cost way to get funds out of your house and to be able to buy the next house. And the third option is to do a bridge loan. A bridge loan is a private lender basically that comes in and says, hey, you have a lot of equity in your home. I'll lend you money. I could turn it around in 10 to 15 days, but they're high cost loans. You pay, you're going to pay 6 to 8%. You're going to pay 1, 2, or 3 points. So on a point, let's say on a $300,000 loan is $3,000 plus 6 to 8%. You can get a home equity line of credit for no cost and a rate of 5 to 6%. So, it's smarter to try to do the home equity line of credit. I think times when someone who used a bridge loan is when they can't get a home equity line of credit, or something has just come up that they need to make a move and they need this money in 10 days. So that's typically when we see someone use a bridge loan. But that money can be used for the down payment on the next house as well. So the ability to use the rental survey on the departing home, and it's not a rental agreement. You're not committing to rent it. You basically just get the survey that says that's how much it would rent for, which I think is pretty smart because the underwriter is basically sitting there saying, what if you change your mind? What would it rent for? Okay, great. You can go still buy a house. I mean, it's a makes sense type loan, and it's very hard to do. I don't know of a retail bank that will do that.
Yeah, that sounds really innovative, especially in this type of market with such low inventory that you really want to find the right house before you commit to selling yours.
Right. Yeah, absolutely. I think, and I'll just say this, on average, I've been watching this, we're somewhere between 500 and 700,000 in price point, in terms of they're going to get approved for 5 to 700,000 higher than most retail banks. That they'll come to me, say, I got pre-approved for 1.1, and we get them in a house at 1.7,
which is a big difference.
Using that rental survey program. Yeah.
We get a lot of clients that, when we're doing a good job, they're not paying much taxes because they're not showing a lot of income or whatever, right? But they have a lot of assets, but they still have a hell of a time qualifying for a mortgage. Is there anything those clients can do to get qualified for lending? Does investment income count? Does it have to be like earned income or wages? Sometimes the underwriters ask them to like pull money out of their IRA for a little bit and put it back in and all kinds of funky stuff. Do you have those situations come up?
Yes, we do have that come up a lot. If you're of retirement age, you can actually use IRA distributions as a source of income. So that's one way. So you can increase your IRA distributions, use that as a source of income, right? So that's a great way, but you gotta be of retirement age. If you're not of retirement age, or either way, you can use an asset-based loan. So an asset-based loan is basically, taking an asset in your account. You don't need to move it anywhere. It still stays wherever you have it, with whatever firm or investment or bank you have it in. You take the asset, and then there's quite a few portfolios we work with where each one has a different calculation. So you take the asset, one might be the 10-year treasury yield amortized over 30 years, or, there's lots of different portfolios. Some are based on age, and then they do a calculation and they'll give you an income associated with that asset, even though it's not earning that. And then some of the portfolios will, in addition, allow you to use interest and dividend income on top of that. So I have done this for, somebody at Facebook who sold prior to the IPO, took their asset, and then just qualified them off that. They were actually volunteering from then on. They weren't working on a job, and able to get them a loan. Yeah. So asset-based.
Because they got plenty of money, but they just don't show any income.
Yeah,
right?
Correct. Yeah. So there's some cool portfolios out there that will create an income or a future calculation of income, because they're looking at, like, if you were to deplete that income over that asset over time, could you pay this? And, a lot of times, and I've heard people come in, they go, I have 5 times the asset of the loan I want, and I can't get a loan.
Right.
Why, so yes. And then
that's not reasonable.
Yeah. Yeah. And then there's actually just another program we just did recently for somebody who, had great assets, but it wasn't, some of the big numbers that you think you need. And they were able to get a loan in Sacramento on a home. And, as she was transitioning to go be a teacher up there, and had some money she inherited. So there are some good loans. She wasn't of retirement age, and it helped her get a home that she didn't want to move until she had the home, and then she was going to start her job up there. So it worked out real well.
Are there limits on like the number of properties you can have a mortgage on and that kind of stuff? Because I have a client that has like a bunch of rentals, and he said he's running into these limitations on like how many loans he can actually even have in his name and everything. And he has like plenty of assets and equity in all the homes, but he's still having a hard time like getting lending on the subsequent investments he's making and stuff. Are there limitations that are like government limitations, or are these just like per bank or what?
Yeah, there are limitations. Mainly, there are government limitations when it's a conforming loan. So loans up to 679 have one set of rules, and then there's a lot of portfolios that have different rules. So typically, you'll hear 10 properties maximum. You can't have more than 10 finance properties.
Yeah, you're not allowed.
Right. But we have some portfolios that have unlimited. As long as it makes sense, but they don't want to do more than 4. Like you can have 20, but they won't do more than 4, right? So, they don't want to have as much exposure. So there are lots of options, but that is
You're
true.
paying a higher interest rate probably though to get that.
In some cases, but not always. There's some really good portfolios that if they limit their exposure and they say, hey, we'll do we'll do 4 total. We can't do all 20, but we'll do 4. And you get a good rate. You don't pay a premium on it. But when you come under the Fannie Mae limits, that's where you start to see limitations on the Fannie Mae 30-year fix, where they typically have, no exception to the rule.
Does owning like rental properties inside an LLC or something impact any of the lending or qualifying or stuff like that?
Yes, they absolutely do. Most banks will not lend to properties in an LLC. They do. We actually have 2 portfolios, I think, that allow it, but I would say the rest do not allow you to lend because they want the borrower to be the commercial loan might do it, right? A commercial loan might say, okay, I'll lend to the business, but residential loans, 1 to 4 units, they want to lend to the borrower, and either their name or the trust can be on, but a business cannot be on title. But there are some portfolios, again, they're not selling the loan, they know what's going on, and they approve the LLC, and they'll allow it. But yeah, it is much more difficult, and you will have less products, like typically 5 or 7 month ARMs, not the standard 30-year fix when you do these loans.
Okay. And you have to guarantee those loans, I would imagine?
Yeah, everything would be based on, they'll personally guarantee just like your credit, income, income, credit, and assets, but they allow it to close in the LLC. One question I get a lot is, somebody wants to buy a rental property and they don't have any rental property ownership experience or rental property loans. And a lot of banks will say, in order to do that, you have to be able to carry your current house plus the rental property and your income. We're not giving you the income that rental property will generate as a source of income.
And what's the debt ratio they need to be thinking about here? What's the bank looking at?
Banks typically, the standard rule is 43%, right? So you're saying your minimum debt payments on credit, auto loans, and the house in relationship to your gross monthly calculated income is 43%. We have programs that go to 49%, and FHA and VA loans can go higher than that. But typically those are the debt ratios. 43% is standard across most lenders across the U.S. And then different exceptions can be made up to 49 and slightly over that. So, but on rental properties, the challenge is they sit there and they go, okay, I can't buy a rental because I need the income on that property to help qualify. So we do have some programs that will allow a first-time investor to use the rent that property is going to generate to help buy it. So that's pretty cool. Otherwise, most banks will allow you to do it if you have a 2-year history of ownership. So as long as you have 2-year rental history on your tax return, then you can now buy another rental using the rent to help qualify for it. So,
and would it be that similar situation where you talked about before that they would have like a rent study and they would take a percentage of that rent? Is that how they would qualify for it?
Yeah, absolutely. That's right. It'll do a rental survey. So with the appraisal, when you buy the property, the appraiser also says this single family or this fourplex, it could be a 4-unit property. Each unit rents for X. Now it's generating $8,000 a month. You take 75% of that, and that's your income to go qualify for it. So, because that's where it's the challenge is someone goes, well, I can buy a $400,000 condo and I qualify for that without needing the rent, but I can't on a $1.6 or $2 million fourplex.
Sure.
But if that fourplex generates $8,000 to $10,000 or more in income, now it might be possible if you have the funds to put down.
Interesting.
So that's a great program for somebody who's looking to invest money in the market.
What about, do you work with clients that are investing out of state in the rental markets and that kind of stuff? Does the state matter, the location or anything, or these programs are nationwide?
Yeah, most of everything I'm saying except the rental survey program is nationwide. The rental survey program is pretty much Santa Cruz up through the Bay Area and some places in Southern California. I don't do loans outside of California, so I do have RPM has offices, and I know other loan officers in other states that I would recommend that, I would say would do a good job, do the type of work we do. So I usually just refer them to somebody that's reputable and knows the local market really well. But most of the programs I talked about do cover most of the United States except that rental survey program.
Okay. Actually, another thing I just thought of is, is there special stuff that comes into play when you have people that are here like on a green card or like a visa for qualifying for loans and foreign assets and that kind of stuff? Like, what do these people need to think about if they're looking to buy a home here?
Oh, great question. Yes. And I meant to bring that up earlier. Yeah. So I think that, yes, we have such a diverse area. It's awesome. It's some of the smartest people in the world, especially in the Bay Area with all the tech growth. And, we see a wide range of visas. So yes, H-1 visas, there's never a problem. Obviously permanent resident alien, H-1B visas, All these visas are all acceptable by lenders, but there are a couple that are a little more challenging. And so that's one reason to get all your documentation in up front, have it vetted by an underwriter, because sometimes it may be expiring soon and they're waiting on the application to come through, and it'll always get renewed, for our clients, but we have to be able to provide the documentation to prove this to the underwriter. And we're seeing a lot, there's special visas for like, if you're a scientist, so you have these visas for scientists that are highly intelligent, and so it's kind of cool to see some of the different visas and why they got these visas.
Mm-hmm.
You meet a lot of great people that way, but, yeah, it is something to be careful to be aware of. Sometimes there's loan limitations or down payment limitations. So some visas will say, okay, yes, we may be able to do 10% down on a purchase price of 1.8 million, but with this visa, you have to put 20% down. So that's just a lender specific requirement, depending on which visa and how long it's valid for.
So just come to you as early as possible, obviously, just to make sure all the ducks are in a row.
Yeah, that's correct. Yeah. And I mean, there's, I think all of them we can do. And if I know, like, let's say an EAD card is pretty common. Those get a little more.
What's an EAD card?
Employment authorization document. I'm pretty sure that's what it stands for. So it's a type of work permit to allow to work. And so those are some underwriters, some banks, if you're dealing with a bank and their underwriting, platform is in the Midwest, they're not aware of it. So it's really good to have local knowledge, local bank that knows what's going on more. And so by having all these programs, we'll vet it out. And then I'd say 99% we can do them. And there's 1% one time where a specific type of EAD card is not allowed. We know where to go, and we'll just tell the client, hey, here's the place to go. It's the only one that'll do it. So we try to keep track of all that.
That's cool. What about foreign assets qualifying for loans or like foreign sources of income? Is that allowed, or does that present a problem?
For most programs, it is not allowed as a source of income unless it's on a U.S. tax return. But there are portfolios, so there's always these exceptions. There's a portfolio where we can do a loan right now for a foreign buyer who is not a citizen, who does not even have a social security number, but they do have to have a tax ID number, and they live and work overseas, and they don't work here. But now they're going to put 40% down, but they can buy a house and get a loan. So that does exist.
It's pretty creative.
I've done that. Yep. So that works. There are, you do document, but you can bring funds from overseas. We've done that from a wide range of countries, so you can bring funds for a down payment. You can do it for reserves. We actually did a loan for a client where we documented some of his reserves in a bank in the UK. So, that worked fine, and he brought his assets over, and we actually did use his tax return from Europe and India. He had two different returns, plus his U.S. return as a source of income. So it all, again, different portfolios that have an appetite for, well-qualified borrowers. Yeah, different situations. Yeah.
So you got a lot of options, which is what I keep hearing.
And which is what is needed, I think, in this era. Never surprised. I mean, I've done a lot of loans, seen a lot of situations, and every year I learned something new.
You mentioned earlier in the podcast digital currency, so Bitcoin, Ethereum, Litecoin, that kind of stuff. You're seeing that creep up now as far as like assets that show up on the disclosure statements and everything, and how are the lenders looking at that kind of stuff?
Yeah, that's a good question. I mean, they're trying to figure it out too, right? Because it's so new. But yes, we did have a client. I mean, basically they say, hey, I have one Bitcoin I'm going to use as my part of my down payment, so they have to convert it. So yeah, we've documented it as an asset. It can be used. And so I can't say I've tried it with every type of loan right now, but I think most underwriters would accept it as long as you teach them about it. You have to show them, give them proof, documentation. I mean, sometimes we printed stuff out of like.
You have a higher opinion of underwriters than I do.
Well, yeah, I mean, sometimes I have to go to irs.gov and print out a thing and point out, say, hey, look at the rule here.
Yeah.
You got to count this income,
Right.
So sometimes you have to, and the great thing is, I mean, a lot of the underwriters we work with, there are some tough ones that you're just like, make no sense what they're asking for. I mean, really, and then but for the most of them, especially now with all the complicated scenarios, I think they're getting, up to speed on what's needed. I remember years ago where RSU income could not be used. We'd only have like two sources for RSU income. And you tell someone from Google that as, GSUs,
right.
They're sitting there going, are you kidding me? And I'm looking at it going, that's the way Bay Area compensates. I mean, it's like a bonus, right?
Right.
And, they're going, well, it's an asset, and you're just like, that's where I would have that same feeling you do about underwriters when that comes up. Are you kidding me right now? And finally, I would say there's a lot more options for using RSU income.
Takes them a little time to catch up.
Yeah, exactly.
Yeah, it makes sense.
So I think also when, picking somebody to work with to help you with your loans, I think it's great. I personally have a fantastic team. I think it takes a team in all these different scenarios we've been talking about. There's no way I could sit here and say, I talked to the client, look for the rate, analyze everything, find this program, this visa type, that type of income, and then close a loan all in 15 days.
Mm-hmm.
It's just impossible for one person to do that. With the demand that we have and the speed in this area. So having a team and working with somebody that has a team, I think is important because people want their answers quickly. And if I'm in a meeting and you have somebody on your team that can be researching, getting back to people, it's critical. It's critical. And there's so many moving parts to the transaction with the speed. And, one mistake of signing a disclosure on the wrong day can delay your transaction 3 or 4 days. So being able to stay on top of all that, it really takes a team to do it. So having a good team is real important.
Yeah, and I can vouch for that. You guys had a really good team, and you included everybody in the email, so they were all responsive when the stuff came up or whatever. So
yeah, it's necessary. I mean, I'm sure like you guys and all the different tax returns and tax laws and keeping up on everything as it changes. I mean, it takes a great team to do this well.
Sure. So how can our clients reach you in the future?
Okay, so a good way to contact us is through my direct line at 408-583-3205. That rings to me and my whole team, so somebody will be there to answer questions right away. Schedule a time for me to talk with you if you're available when we're available. And you can also reach us at www.rpm-mtg.com/BKNAPP. So that's a good place to reach us. And we're on Facebook, and we do put out a lot of great information. I try not to bombard people with articles that aren't important, but more just timely, tax law information, mortgage related information that will help them when they're ready to make a decision to buy or refinance a home.
That's great. Well, thanks a lot for coming on the podcast. I really appreciate it. This was awesome.
Thank you so much for joining us today. I definitely learned a lot. I haven't purchased a house in 12 years, but it's really an eye-opener, so appreciate the information today.
Yeah, thank you so much for having me. This is awesome. I mean, for you guys to do this for your clients, I think is incredible. I'm just blown away. So thanks for having me and truly enjoyed it.
Well, that's all for today's episode of Debit This, Credit That podcast. As always, if you have a question, you can contact your Wheeler Accountants Preparer or submit a question online at our website in the Ask Wheeler section at the bottom of the page. Please remember to follow us on social media for regular updates at Wheeler CPAs and on LinkedIn and Facebook. Thanks for listening as we help you solve for accounting.